As remote working has opened up in recent years, there are now more digital nomads than ever. A lot of people are traveling all around the world on tourist visas and working from these countries while they are there. But what happens if you inadvertently stay long enough in a particular country to become a tax resident? And is this even possible whilst on a tourist visa? In this video, we're going to take a closer look at how you can quite easily become a tax resident on a tourist visa and what are the implications of this, because they potentially can be quite significant. So yes, it is possible in most countries to become a tax resident on a tourist visa. In most cases, it comes down to the number of days you have spent in the country and not your visa status or the type of visa that you are on. Whether you are on a longer term visa or a tourist visa, if you have stayed in that country long enough to meet their tax residency rules, then by the tax laws of that country, you can be a tax resident. This will usually require multiple entries. If we're going to use somewhere like Thailand as an example, to become a tax resident in Thailand, you have to be present in the country for 180 days or more in a tax year. Now, with a typical tourist visa being 60 days, or it used to be 30 days, and then you can extend for 30 days in country, that's only going to get you up to around 60 or 90 days. So that means you're going to have to leave the country, come back in, that kind of arrangement. So usually if you're just doing a single entry on a tourist visa, you will be fine in most cases, in most countries. But if you're coming and going a little bit and you happen to clock up that 180 days in that tax year, that's where there can be some taxation implications in that country. Most countries do set tax residency at around that 180-day mark, 6 months of the year. And if you're interested in learning more about that, we have got an article up on our website that tells you what are the tax residency rules for each country in Southeast Asia. So if you're interested in that, you can head over to offshoreinasia.com, go to our taxation section in our blog and have a look there. So why is this important? It's very easy, especially for a digital nomad, to not give too much thought about this, to not get too tied up in what the rules are in foreign countries that they're staying in, especially if they're still paying tax back in their home country. But you have to be very careful with this, because if you do become a tax resident in a foreign country that you have entered, under a tourist visa, under any visa, they then have a legal right to pursue you for taxation. So what does that mean? Well, this means that you could be faced with double taxation. If you've already paid tax in your home country, then you have to pay tax again in the country where you are staying. Often there are credits available to offset any double taxation, but for that you will have to review the double taxation agreement between these two countries. So as a best case scenario, it can still be a bit of an administrative headache. It means reviewing the tax treaties. It means hiring an accountant in the new country to make sure that they claim all of the credits and you don't get taxed twice. So there's an extra cost there as well of having to employ an accountant who is familiar working with expats. But where it can get really nasty is if you had a particular tax event in your home country, or you had a particular type of income or capital gain that was taxed concessionally or not taxed in your home country, and then this other country, the country where you are staying, who they also deem you to be a tax resident, they might not have the same concessions available. A type of income that might have been tax-free or low tax in your home country might be taxed quite highly in this other country. So that's where you have to be very careful. So for example, to use Australia here, with property, there is pretty good tax exemptions available. There's tax exemptions on the primary residence. There's discounts on capital gains tax for investments. Not only is it possible that you could lose access to these exemptions in Australia, but this stuff might not have any tax exemption in Thailand or Malaysia or wherever you're living. So something that you thought may have been tax-free may not be tax-free anymore. If this is a large transaction, such as a sale of a home, that goes from being tax-free to taxable, that can turn into quite a large tax liability. Other things you have to be aware of are pensions and other retirement accounts. Do they have tax-free or concessional taxation back in your home country? Do they get this beneficial tax treatment in the new country? Sometimes they might, sometimes they might not. Again, it's something you need to be aware of and know where you stand. And another big thing that flies under the radar a lot is inheritance. Some countries don't tax inheritance, some countries do tax inheritance. You might have had a tax-free gain in your home country, to all of a sudden find out that the country you're living in wants to tax this $1 million inheritance. So that can turn into quite a lot of money if you plan it incorrectly. So what do you have to do to not get caught up in this trap? Well, have a really good understanding, plan out where you're going to stay, count the days, especially if you're coming and going on a couple of visas throughout the year into one country. Count how many days you've stayed on each country to make sure that you don't cross over that 180-day threshold or whatever the threshold is for that particular country. Now, maybe you do want to become a tax resident in this other country. That's for another discussion. Whatever you're trying to do, just have a solid plan and stick to it. Just know where you stand so that you can tax plan around that. As I mentioned above, if there is a DTA, a tax treaty between these two countries, have a good look at that. These are publicly available documents. That said, they are often worded quite ambiguously and not always easy to make sense of. So if you have any confusion in your situation, and it's not a bad idea in general to seek out professional advice, go talk to an accountant who is familiar talking with expat matters, because a lot of accountants just regular accountants who work domestically don't really get a lot of exposure to expat and international taxation matters. So talk to someone who works across the international space and understands both sides of the coin, the country that you came from and the country where you're going to. You want to make sure that if there are any credits or offsets available, that you are claiming these. If you have discretion over when a particular gain is going to take place, like a capital gain, you want to execute that gain in a time when you know it's not going to have big taxation liabilities for you. So do some planning around that. And if necessary, you'll need to lodge a tax return as well. It's not always needed. Again, this is something you might need to consult a professional in the country where you're living to find out whether there is a requirement for you to lodge a tax return or not. But again, just know where you stand and know what your requirements are, particularly when you have some big money moving around or a big tax event that you want to make sure for certain that you don't get a nasty surprise on the taxation of it. So guys, if you are interested in talking to a firm who works in the international space across multiple tax jurisdictions, you can get in touch with us over at offshoreinasia.com. If you have some pressing matters that you want to address right away, or if you want to have a one-on-one confidential discussion with a tax professional, you can book a call as well over on our website, and we'll help you to work through whatever is on your mind taxation-wise and any other matters that may come up in relation to your expat life. Thank you for watching. We'll see you later.